So I thought something interesting to discuss would be kind of where we are in the market. You have a super unique insight, given the kind of people that you hang out with. And it seems like what's happening in the market is changing on a weekly basis. And especially with interest rates and kind of where we're headed. So would love to kind of a big picture and then maybe some more kind of micro things that you're seeing and happy to add on to that as well.
Sure. Hey, everyone. Just want to welcome you to the Sunrise in Chandler live Q&A, and we're here to answer any questions you have. I mean, you've probably seen the deck. You may have even seen the webinar. You may have seen all these things, and maybe you haven't. I don't know. But wherever you're at, we're here to meet you where you are. We're here to answer your questions about this deal, this opportunity. We're happy to share why we're excited by it, but also answer any questions that you might have. And that's what we're here for, to be here in front of you, answer with honesty, transparency, and of course, Pranay's got his whiteboard there in case we need to do some
Use
some
it.
work there. But yeah, and also you can ask a question about anything about the market, about things we're seeing. And then so the first question that came up that Pranay asked me was, and something that is more like we'll just do a little bit of a discussion here about what we're seeing in the market today and what's been happening. And I think it's important to look at the past for the past couple years to understand where we're at today. And even before that, if you think about it, we were in a rate of really low interest rates for a long time. The Fed, who is kind of in charge of how money borrowing and lending happens in this country, they set a rate, and by that rate, then other banks kind of have to follow suit. They set the rate essentially at which banks kind of lend to each other, or they lend to the bank. And then they have a little bit of a margin on top of that, and then that gets passed down to you and your mortgage and things like that. And so for a long time we had the Fed put the federal interest rate at basically they're lending at a rate of zero. And what that did for a little while was that made it really, really simple and motivated people to get into assets, to borrow money, to set themselves up in where there were some decent amount of leverage. And so we were in that environment, and when people are able to borrow really freely and buy with like free money, what happens to asset prices? Prices go up over time. And then we hit a place where inflation, that we all know, inflation started to rise after the pandemic. Tons of money was given out, tons of free money. It messed up pandemics messed up supply chains too. And as a result of all of these factors, free money out there, supply chain issues, all this stuff, the price of goods and services started to go up over time. And most people, including the people at the Fed, Jerome Powell, all of these people thought that this was going to be transitory. So they didn't really react right away. They saw inflation start to rise when, their normal target is somewhere around 2%. They saw 3%, they saw 5%. They saw these numbers. They're like, okay, it's just going to go down. It's going to go back down. This is transitory. So they didn't actually make any moves. Then once it finally started to double, even from the place where they thought it was going to be transitory, they decided we've got to take extreme measures because this is moving in the wrong direction. We don't want this to be a repeat of the 70s, the late 70s, 80s, where inflation was out of control, where again, the price of goods was skyrocketing. And so they decided to pull the lever and decided to raise interest rates. And what they ended up doing was raising interest rates at a level that we've never seen, well, we haven't seen in 40 plus years. And so anybody who's in real estate today, I would say for the most part, many of them, most, if not all of those people have never seen interest rates rise as fast as they've ever seen it. And it created a lot of volatility and havoc in the market, because we all know that the how lending goes in the real estate market really impacts prices and values and things like that. And inflation still continued to stay high. Interest rates were high. And so what that ended up doing in our market, when we do a lot in commercial real estate, it made it really, really difficult for people who had floating rate loans. So the loans and their rates would go up over time. So their debt and the amount they had to pay in debt would go up over time. So their numbers wouldn't work. So they started having some challenges and struggles. And then also when people wanted to at least sell their buildings, then people would have to put new debt on that was higher value. It just really decreased the demand for those type of properties, and so prices went down there too. And so we were left in an environment, especially in the last couple of years, where we've seen some challenges in the marketplace, meaning that Number one, for some properties, they've had problems covering their debt and actually having a viable business that cash flows. And then for other people, like if they need to get out of a property, they haven't been able to sell at good value. In fact, they've been selling for maybe even far less than what they bought the property for. But sometimes they have to sell for whatever reason. And so we're in that environment today where interest rates are high. We're still seeing them in, I don't know, 6 to 7%. For you buying your own primary homes, you might have seen it above 7%, 7.5%. You might be seeing it in there. And so that's the market we're in today. And so everybody's kind of waiting. What is going to happen with interest rates? What is that going to do to the market? And at the beginning of this year, the thought and the basic sentiment when the Fed had their meeting was that they were going to have 3 rate cuts in the interest rate. They're going to drop it 0.75%. Everyone was anticipating that. Many people thought it was going to happen starting in May. But guess what? It's May. Inflation still remains higher than they expected. In fact, it seems to be slightly trending in the wrong direction again. And so we haven't dropped interest rates. And so maybe it'll happen once by the end of the year, maybe twice if things work well. But we're kind of at a standstill. We're kind of at the mercy to see what happens with inflation, and that will ultimately dictate what happens with interest rates. Now, when we look at perspective, we all think like, oh my God, interest rates are crazy right now. And for from where we've come from, yeah, it is. I mean, I don't know if any of us have seen interest rates in 7.5%, 8% for a while. But people who have lived through the 80s, they got a home mortgage 15%. And that's been there before. And so it's all about a little bit about perspective. Now, the hope is that we don't get to that place. And I think it would really cause damage to the economy. We have a huge national debt, which is also dependent on the interest rates that are out there. The US is paying at those interest rates as well. And so as an economy, as a country, it's not sustainable for us to continue to pay at these high interest rates. So something has to give at some point. I know it's a long-winded answer to say we're at this interesting place right now where interest rates are high, inflation is still higher than people expect, and the market, in terms of the commercial real estate market, is undergoing a transition where people who are selling that don't want to sell, sometimes have to sell, they're selling at far less than value. And so we're transitioning from the opportunity, to the place where, there's a lot of fear here to moving into a place of opportunity for people who have cash, and a place where people can buy and purchase these properties at a bargain. And so you don't want to be a seller right now. You want to be a buyer. And that's what we found in the marketplace. We're finding values 20 to 30% below where people bought it. And, again, if you have the capital and cash, people are starting to pour back into the market slowly. There's some big institutions that are starting to put money back into real estate. And they were stockpiling cash these couple of years, and now they're starting to go back. And that's when these institutions come into the market, is when the prices start to move back in the right direction. Now, we don't know where the bottom is. I think, Pranay, you showed me where you listened to a podcast recently from some big lenders who stated that this may be very, very close to the bottom. And they expect that, but nobody really knows. Let's be honest. Nobody knows when that time is. But again, near the bottom, and if you just keep buying through that period, you know that there's an opportunity there. And so it's just a fascinating place in the market. Nobody knows what's going to happen. And so the key is to try to identify opportunities, mitigate risk as much as possible, take into account the scenarios on both sides, and then set yourself up for that. But I will say that during these times of downturn is when they say the greatest transfer of wealth happens. In any downturn is usually when the biggest wins happen, because in real estate, you make money when you buy. And if you make money, so if you buy at a period where prices have come down significantly, in opportunities of in times of distress, that's when the opportunities are. When there's still a lot of fear out there, that's actually when you want to start buying. When you want to be buying, you want there still to be some aspect of fear, because it creates inefficiency in the market and it creates opportunity for people. And so that's where we're at in the market today. Pranay, that's my little 5-minute summary. I hope it did a good job. If anybody has any questions on that, throw them in the chat. Just say hi real quick if you're there. And Pranay, do you want to add anything to that?
Yeah, so it's hard to say where we are in the cycle, but and I can share this video, but a lot of the big players, BlackRock, Camden, people who own the most real estate in the US, are actually starting to buy. So Blackstone, for example, just bought 10 billion with a B worth of real estate because they think we're at the bottom. So we're they say that interest rates are going to be high for a while, and that it's still an opportunity to buy despite that. So, as Peter mentioned, and I'll use Sunrise on Chandler as an example. The owner, they had a $50 million loan on it, right? Um, including everything they put in for renovations, they had 60 million into the property, right? So meaning that all in, their value, the owner, who's a large New York bank, had 60 million into the property. We're buying it for 46 and a half. So unfortunately, the equity for the owner is going to get wiped out. And one of the things about real estate is that at least partly it's a zero-sum game, right? So we get to benefit a little bit from their greed, and even the lender is taking a haircut, and that's actually pretty rare to happen. But because they know that the property actually appraised for 49 and a half. So we're actually even getting a discount from current values, because what you'll see a lot of times is you'll see someone bought something for 80 million, right? And they're buying it for 70 million. You're like, wow, I got, 10% plus discount. However, the current value is 60 million. So this number, which is called a broker's opinion of value, is what a broker, the person who would be actually selling the property right now, thinks that they can get for this property. So we're actually getting it for a 3 million discount from the current value, what the broker thinks that they would be able to sell for. And so that basically means we have 3 million in built-in equity. And compared to what they paid for it, we're getting a $13.5 million discount. Now I know this number looks nice and big, but here's the number I really care about. If I gave you something that's worth $10 and I sold it for $7, that'd be pretty cool. It means you immediately gain $3, and that's why we love this deal. We're gaining immediately equity and 3 million. Plus, we have 5 years to increase the value of this property, and only 11% of it is renovated. So there's just a ton of value add opportunities in this specific deal. So usually when you see a deal like this, right, with a large discount, you're like, okay, Pranay, what is actually wrong with this property, right? Why does no one want it? However, this property, we're getting it off market and it's 97% occupied. So people love it, and there's no evictions or bad debt. Actually, so last month the bad debt was 20 bucks. 20 bucks. So that means everyone is paying on time. There's no evictions.
Explain what bad debt is for
Yeah, yeah. So
what that means.
when every month you collect rent, right? You collect rent, and then people are late, right? Maybe they didn't hit their paycheck, or they spent too much money, or maybe they got fired and they're just not able to afford rent, right? So bad debt is debt that you're concerned you might not be able to collect, right? And there's not only is it money that you're owed that you're not getting, but it costs you effort to collect that, right? So even if you get it in full, it actually costs you something. So to have bad debt of $20 uh, is basically nothing, right? So that means the property, people love it there. It's occupied very well. It's going to cash flow immediately because, so right, as I told you, they have a $50 million loan on this property. Our loan is going to be about 30 million. So that means our largest expense, the loan, is going to be much smaller than what they're paying. So the property is going to be cash flowing immediately. So the first check will go out in a couple months. As soon as we close the books in a month and a half, we'll be sending out our first distribution of about 3.5 to 5.5%. It goes up about 1% a year, and that gets paid out monthly. So this is annualized.
You're running out of room on that whiteboard.
Yeah, yeah, yeah,
You
yeah.
gotta start wiping in.
Yeah. Yeah, so it's annualized. So yeah, it's and it's paid monthly, right? So, someone astutely said, hey, that's less than the 8%. But the 8% preferred return, what that tells you is that we're not going to see, as the sponsor, the co-sponsor, we're not going to take a dollar until that 8% gets met per year. So if it doesn't get met in 1 year, next year we owe you whatever is left over. So if we give you 5% in the first year, next year we owe you 11%. And it keeps going until you get paid back in full. And then we'll give you all your money back. And then finally, we'll do 75% to you and 25% to us. So our compensation is very backloaded, but we believe that as investors and investors ourselves, the investors should be rewarded first with the spoils, right, of the property as people who are investing, believing in us, trusting us with us, and partnering with us on this deal.
Well, Pranay, by the way, if anybody has any questions, you're welcome to throw them in the chat for us because again, we'll try to address all these. First of all, there's no bad questions, so these are all great questions. Pranay, do you see the questions that are up here right now? I
Yeah.
think Jeff has asked some great ones here. Why did the New York bank not come back in the deal since it's not a total wipeout? But we'll talk about that. And they must have gotten back their loan in the deal. So maybe you could explain that a little bit.
Yeah. So let me read it.
Maybe you need to explain a little bit again about
Yeah.
the
So
loan that came, yeah, was there, and then what the new loan and that sort of thing.
yeah. So so last week I talked about the power of the owner and a person that has major decision rights. And part of that is getting to choose what loan you get, how much leverage you get. And it's the same rights that we have. And even the ability to remove the sponsor if it makes sense. So this New York bank, and a lot of times you see, right, hindsight is 2020. You might think, well, why did they get so much leverage? Why did they get a variable rate loan, right? We didn't know that interest rates were going to go up that high. And this could be considered maybe something high risk in their portfolio. But if you have $1 billion portfolio, then you have some high risk, you have some low risk, and you have something in the middle. So we don't have a clear picture of what their portfolio looks like, but maybe it made sense, right? So I like to always think that people try to make rational decisions. It's just sometimes those decisions are wrong, and we benefit from it. So they took a variable rate loan on the property initially, right? And that wasn't enough leverage for them. And they got a second loan called a mezzanine loan or junior debt. And combined, it was leveraged about to 90%, which was actually okay because the property was doing so well, it was able to cover the debt. However, once interest rates went up, it went up from 3% to about 9% right now. Uh, it's just no property in the world, regardless of how well it's run, can cover that because it's based on how much your loan is, right? So 50 million. So 9% of that's a lot of money compared to 3% of it, right? So they had an opportunity, right? They have an opportunity to put in more money, right? And they could do a cash in refi, right? Get a new loan, put in millions of dollars. They can just keep covering the debt, right? And obviously, I'm not them, but they thought that they'd rather just take the loss. And if they're a New York bank, they can probably use the depreciation, use the losses against something else, right? So it could be a tax situation. Of course, I don't know exactly what it is, but usually when you're looking at this, you look at kind of a bigger picture like, hey, I only have X amount of time and effort. I'm not going to put it into this specific deal. And we've seen larger players strategically give keys back to certain projects. However, right, they could have just said, hey, bank, all done. This is your deal. However, most, pretty much no sponsor or no owner wants to do that because no one's going to give you a loan again. So it made sense for them to sell to us at a loss because we're going to get a new loan off. We're going to pay back the original loan, and it's a mezzanine loan that's going to take a haircut. You almost always want to pay back the senior loans. Senior loans are very angry if they don't get paid back, and you may never get a senior loan again. So the senior loan is definitely going to get paid back, and it's the mezzanine that's going to take a haircut. But they're, it's riskier. It's in the second position compared to. Yeah, how's that, Jeff?
Yeah. Okay. I think Jeff had some questions about how we're structured. I think these are great questions because I
Yeah.
think we actually love taking these questions about how we're structured because there's a lot of misunderstanding when it comes to that. And it gives us a chance to talk about what we do and why we do it and how we feel we're different from people out there. And so there can be a misunderstanding about our role in terms of Ascent Equity Group in terms of a deal like this. Like our role, by the way, is we're at the top level. We're not just somebody that just feeds capital into a deal like this. We're either what's considered a JV partner or a co-GP. And as such, whenever we go into a deal like this, we have full decision rights. And first of all, that's not easy to get. I mean, if you're going to partner with someone and you partner and you find good, like usually you'll find a situation where one partner it's up here and then the other partner is down below here. But we felt that if we were going to do these deals and these opportunities, and that was one of our kind of core principles when we decided to get into, started to build Ascent, is that how are we going to safeguard our investor capital, our partners' capital is what we really consider it. How can we do that? How can we make sure that we have a seat at the table so that there's transparency there, that we ultimately the decisions that are made when it comes to operating the property, selling, refinancing, all that stuff is really slanted and really in the interest of everybody here in our community. And we felt the only way to do that was to have the decision rights. And so anybody that we go with and we partnered with in the past, if that is not on the table, and most people don't want to do that, the deal is off. We don't do deals that aren't like that. And the reason we do that is, like, here's an example. We've had opportunity, have properties where, let's say we felt the property management was underperforming. And maybe that was the property manager that our operating partners brought into the deal, but we felt they were underperforming. So we've had situations where we've done the evaluation, with our asset management team. I'm going to explain that in a little bit, and gone in there and said, look, we need to change this. We need to change course right now. And so we've gone in and put our own property managers in there, righted the ship, completely changed the trajectory of some of the deals. And now some of those deals are thriving, and we feel like that is the kind of active involvement that, a group like ours should have when it comes to this. If we're truly going to safeguard people and really say that we're going to take care of our partners and do that, right? Take care of our investors and people part of our community. Like, we can't just rightfully just put in the cash and just hope and cross our fingers. Like, that's not who we are, what we do. And so what we've done is, on our side is we usually bring in partners, and the partners provide their own value, and then we provide our own value, meaning that often our partners, for example, Sunrise, they have a fair level of experience just in this area, as we do too, in managing and operating property. They usually deal with a lot of the financing terms and deal with that, and some of the things on the acquisition side, these personal connections. But on our side for Ascent, not only do we obviously handle, deal with our community, and, provide the education and the connection and then safeguard them, we also built a robust asset management team. And what that means is that not only do we, when we come to the table, we're in all the calls with them. We know exactly what's going on. In fact, we're a lot of times, in some situations, we're actually driving the ship. So in most situations you'll see is like the certain partner has an asset management. We've also have asset management. So together we are actually working to make these decisions. And so we've actually brought in and created our own asset management team over the years with not only people from our side, but also we brought in some people who have been, serious experience in the industry, who have looked after billion-dollar portfolios, who are part of our team, to be able to do this and be on our side, right? Not someone who's biased, to look after these investments and make sure that things are moving in the right direction and that we can take the action necessary because we've got the decision rights. But who cares if you have decision rights if you don't know what's going on? And so we are in it. We're in every deal. We know what's going on, and we're actively involved in operating as well too, even though we have a partner in place. And so that's something we're really proud to have built. It's something that's obviously more time intensive from an operational standpoint for us. It's also more intensive to have a bigger team. It's obviously comes at more cost too, but that's something that we feel is the right way to do this. And we don't see a lot of people doing it like this. In fact, I don't even know if there's anybody who does like the same way we do. And so we felt that was the right way to do it, especially because we care about our community so much and making sure things are going to go well. Pranay, what can you add to that?
Yeah, so great explanation, Peter. So I think really syndications are split into kind of three verticals, where one, you're doing acquisitions, so you're finding the deal, negotiating, right? You're running the property, enacting the business plan, and you're raising the capital. Now, we play a role in all three of these, but where we really shine is raising the capital, reaching out to our network, educating people, and asset management. So Jeff talked about who our asset management team is. His name is Brendan and Tony. They both combined have almost 30 years of experience. They used to work for a large family office, and they are third party, but they predominantly work on our properties. We have 10 plus properties, so we keep them very busy. And so we like having, we actually like using a lot of third party agencies because we have found that if you bring everything in-house, it doesn't keep that competition. And actually, vertically integrated, we've had issues with in the past because it you don't have that competitiveness, right? So
Not even
they,
just competitiveness, Pranay. It's just a new thought, new idea, a new
yes,
perspective.
yeah, yeah,
Again, if everyone's in house, everyone's kind of like, yes, yes, let's do it.
yeah,
Like you need what we found is we brought in people from other places. Like we want people to say no, and so we want to poke holes, and so we bring in people that are, again, from different areas that aren't necessarily always connected, but we want to hear their opinions and ideas so that we can make sure and we bring them all together, but they have a difference of experience where they're coming from and different ways of looking at things. So that's really helped us as we built out our portfolio and things that we're doing.
Let me give you a quick example. We didn't end up buying this property, but there was a property in Austin where we were gonna buy it, and someone similarly was gonna they were in a fund and they had to sell the property, so they were gonna sell it for bargain prices. And the sponsor said, "Hey, we're vertically integrated. We already got a quote for this. It's gonna be 12,000 a unit." And we're like, "Yeah, okay, that sounds good." And we started looking at other properties in the area, and we found one property that just looked way nicer, right? Quartz counters, recessed lighting, it just looked beautiful. And we talked to the property manager and eventually the person who owned it. We're like, "Hey, we're a bunch of doctors. We always play the doctor card, when it works out in our favor. And we're interested in investing. Could you tell us who your contractor is?" Long story short, that contractor was $8,000 for a higher level of scope. So had we done that property, it was 500 units, we would have saved $4,000 per unit times 500. So we would have saved a fortune, and to get a higher level of scope. So we really like using a bunch of different partners. And I think right now we've really gotten our team to an amazing level. We're very lean as well, but it's very rare for anyone to hire asset managers. And we pay them extremely well, and they're visiting our properties almost once a month, pretty much all of them, because we only own in a couple different states. And so we're going to start doing, for our investors, we're going to start doing a podcast about all the crazy and interesting stuff because we think really outside the box. Like for example, on one of our properties, we have a short-term rental, a couple furnished short-term rentals in our apartment complex specifically for people in medicine. So, there's always visiting students, visiting fellows, visiting attendings. and we're able to get a premium because it's furnished. They also are at the hospital all day, all the time, so they take very good care of it. So it's just we've really been able to think about these things from an outside perspective. Other places we've been able to add in things like English as a second language or help people kind of build their nest egg 401k and stuff. And it really creates a more community feel. So we're very excited about that. That should start in the next couple
Someone had a good question here. Have you had any capital calls on prior syndications? No, we haven't. Not to our community and investors. So, we're really fortunate that, I would say our portfolio has done really well. Doesn't mean everything's perfect. I'll just be honest with you. Not every property has done perfectly, and there have been a few that have had to get through a little bit of a rough patch. As I mentioned, those are the properties that we've had to go in and kind of change and adjust and make different, again, make changes to it in terms of changing property management, changes to the way they operate, and that was all led by us and our team. I'll tell you that right off the bat. But a lot of times these buildings aren't like they're not race cars where you can just change direction like boom boom, like it's not skiing boom boom. These things sometimes are slow moving ships at times where you have to make the right decisions and make the turns, but by the time it takes a little while for that turn to happen. And so sometimes you need a little bit of I'd say cash to bridge that gap. Now, unfortunately, with what's happened in the market today, with interest rates going up, there just hasn't been a lot of room for error. And so you've probably heard of capital calls. And capital call, for those who aren't aware of that, is situations where, let's say, you run a cash flow issue on your properties, which can happen. Then they've had to go to investors and say, look, we need a little additional more capital to try to bridge that gap until we can fix things and right the ship. And so you probably heard of those things. And sometimes people decide to, participate. Sometimes people don't. And so we've been fortunate that we haven't really had that situation with very many of our properties. Very, very, very small number of them have had some situation with some cash flow, to be honest with you. In that situation, we've actually covered it internally ourselves instead of going back to people. We're already the largest investor in pretty much every one of our deals, but we felt that before going out to other people, we wanted to make sure that people understood that we want more skin in the game, that we want to do things right by people. And so we put our own capital in there to cover these because we totally believe in these properties, in the direction of them. That isn't to say we wouldn't ever have a capital call. I don't want to say that, but we haven't had to do that. Now, we've had some success up to this point, and people said, we've had some properties that have done quite well, and as a group and as an organization, there have been some, we've sold some properties for good profit, and so the business has made some profit on a result of that because the investors made that profit first. What we've done, and our commitment to everyone here, is we've number one said that we want to safeguard people's investment. We know how hard it is to work as a physician, the nights, the weekends, all that stuff, and that we put in a lot of time for this. So we want to make sure, at very least, that investment is protected. So what we did in the beginning is we decided as a group, and we're not shy about saying this, as a group, we decided, even personally, me, Pranay, Myth, as founders, we're not going to take any profit in anything until everybody's investment is safeguarded first. And so if there were situations where we needed some cash to cover some of those things, we said, look, we're not going to take any profit. So just to be honest with you, in the however many years that we've been running this company, like we've done well as a business in terms of, we've raised good capital, we've bought good properties, all that stuff, but we haven't taken any profit. And the reason why is we want to make sure we get through this period. We want to make sure that we get through this period of volatility first and protect everybody's interests first before we decide to take any sort of benefit or anything that might come down the line. And so we've been able to use our own funds personally to invest in that. And we feel like that was the right thing to do. And I think that people have told us that they appreciate that. And I know that this will, in the end, do the right thing. It'll work out in the end. And so we haven't had any official capital calls. In any situation where cash was injected, we did it personally on behalf of ourselves personally, and the company has done that to cover that. So we hope that could that really helps right the ship, and hopefully that will create a great situation where after time we're gonna these properties will continue to do well. So
Yeah, let me add to that, Peter. So those deals that Peter's talking about were some of our first deals, right? And there's a couple things we learned along the way, right? And so they had variable rate loans, right? Of course, we'd always buy interest rate caps, which is an insurance product, which says that after interest gets above a certain amount, the insurance company gets it, right? The other thing that we used to do, and it made sense to us at the time, is really focus on growing net worth, right? For most physicians, we don't need a couple hundred, couple thousand bucks a month because we really want to grow our retirement, grow our nest egg, right? So what we would really focus on is how to grow net worth, right? And so if you do that, you need money in the business, right? Not as much distributions, not as much cash flow. All your money from renovations and rent, you put back into the business to grow, to renovate, to grow the business, right? So the cash flow on those properties were low, which is to be expected, right? Because all the money is getting pumped back into the business to do renovations. And that made sense. However, we really pivoted, I'd say 2022, a little bit earlier than kind of what happened in the economy, to fixed rate loans, right? To remove interest rates, right? Actually, in 2022, we got two loan assumptions where we were able to get sub 4% interest rates. Two of them. Now loan assumptions are really cool, but we did it. We did it before it was cool, right? And what we really invest in now is cash flow. So all of our last our deals are cash flowing. They are cash flowing on a monthly basis, on time, hitting pro forma. So those original deals are going to do fine because they're still growing in their net worth. We're still doing renovations. The cash flow is what had an issue, right? So now we're seeing these deals, and so is Chandler. So Chandler is 3.5 to 5.5%. The other thing is the debt service coverage ratio. Basically, how much money you make compared to how much your expenses is 1.61. So that means we're making 1.6 times the expenses. So that means, the chance of us holding distributions or going down on distributions is pretty low, especially because we have a fixed rate interest rate. So and we've been doing this for a while now, and our properties are all consistent with this, and specifically Chandler, which is why we like it so much. So even though those properties are, we've really righted the ship, we also really took a look at the books, look at what we could have done different, right? Even though no one really knew what was going to happen in with interest rates, we always think, hey, how can we do things better, right? We did, even though the properties are doing well now, we looked at it. Okay, if these do worse, let's do an M&M, right? Even before anything bad happens. So we're always trying to do, I think it helps with the whole physician thing, really with a focus on quality improvement, right? It's kind of chilled into us. So now this pivot has really helped us, and you'll start seeing a lot more people kind of coming around this way. There's a handful of people still doing variable rate loans, but the reason you don't see everyone do this is because fixed rate loans, especially loans with the government, they're hard to qualify for, and they'll only give you leverage up to 55 to 65%. So that means you have to put a much larger down payment, and that's difficult for some people to do.
Okay, all right. Yeah, somebody asked me about the numbers here. I don't know if they do this to everybody, how, how close to the pro forma to actual projection. Again, so Sunrise and Chandler, the cool thing about this property is that we're keeping the exact same management in place. Our operating partner is actually the same one that was there before. So the actual numbers, by the way, are the actual numbers. I mean, it's funny because some people, I remember somebody asked me about this and they said, this looks pretty good. Now, what's going to happen when you change over, right? And I will tell you what one of the biggest risks for any property when you go to buy it is during the transition. You look at what their actual numbers are, but sometimes you don't know for sure. Are those numbers that are kind of made to look a little prettier than expected? And then when you get in there, you find all sorts of things that, and there's always a risk there. And so you try to uncover that as much pre-sale as possible. Try to uncover what are the actuals, what are the actual expenses, this whole bad debt that Pranay talked about before. Like, what are the actual numbers? Is it just what they say? Do we verify and all that stuff? The beautiful thing about what we think about this deal is those are the actual numbers. We know it because it's the same property management and operations. When you look at it, we're going to continue doing the business plan as before. Again, 97% occupied. So that's not changing. We know that to be true. The bad debt is minimal to none, which is amazing. We know that renovations, only 11% of the units have been renovated. We know that for sure. We know what that would cost. But again, we don't have to make any sudden, quick, fast moves because this thing's already cash flowing today. And the only difference, really, I'd say the only difference, but one of the major difference in this is that the loan that they had was this. Now the loan that we have on this was this. And so our debt service, like Pranay mentioned, the amount that we have to pay for our debt on this is significantly lower. So it's almost like resetting we're resetting the price of what we're buying it at, resetting the debt, and we're buying it far significantly below what the original group had it as. And so that's what's really powerful for us. We can take the actual numbers and base our projections, I'd say, based on actual numbers, not what we hope is going to be the case necessarily. So again, well, moving forward, obviously it's always a projection, but at least we're working off actual numbers and the experience that these people have brought into this deal already. So there's not a huge surprise there. So that's why we're excited by it, right? And we know the market, we know the where it's located, where it's continuing to improve, and that just really makes up the story of this entire property in this deal. Somebody else had another question. Hi guys, as rate caps begin to expire again, and with the interest rates not going down in the foreseeable future, what's the general effect on loans and future rate caps? I think it's a great question. I think this is a question that everyone is kind of struggling with or thinking through as an operator, sponsor, and investors are all thinking through that. And banks are also thinking that too. What they don't want is a repeat of 2008, where it was just a complete mess on their books, a complete collapse, and they waited way too long to work with people. In fact, they didn't even get the chance to work with people on it because it kind of happened all suddenly. Things collapsed. And so this time is a little different, as we found, again, in our situation, is that banks, and most, if not all the banks and lenders, have decided that they're going to be proactive about this if the operator sponsors want to be, meaning that they're going to go ahead and extend maybe before it's due, before they have to. They're going to help with some of these rate caps, put it in place, and extend these things out so there's more timeline on these deals. So they don't all run into a situation where they had before, where all these deals come due, they can't handle it, banks start to collapse, this kind of thing. And so Pranay probably can add a little bit more color to this. But yes, everyone knows, and I don't think it's a surprise for anybody right now, the interest rates probably will hold at least for the next 12 months, maybe 18 months, maybe 24 months. And so, I mean, Pranay can tell us we had another property where we got a really nice extension on it just because we asked and we were proactive about it. And we didn't have to do much to do that. And so that just bought more time. And more time on any deal is always a good thing because it gives you more opportunities and options. So Pranay, what can you add to that?
Yeah, so it's time is of the essence, right? So if you owned a bunch of properties in the 80s at 15% and you survived, they're probably worth what, 10x right now, right? So time really solves a lot of wounds, right? In terms of real estate. And what a lot of lenders are doing, if you aren't if you're not defaulted or you're not coming up to due date soon, they'll say, we have all these other people to deal with. Come back later, you know? And so we've had, I'd say, hundreds of emails between some of our lenders. And it gets pretty complicated because your loan will get sold to someone else and sold to someone else. But we had one deal that was expiring in 24. We got it extended till end of 25. We had a deal expiring in 25. We got it extended to 26. So our very first deal is going to expire at the end of 25. So we've gotten every single one of our deals extended, and uh, we only have a handful of variable rate loans. Most are fixed anyways, but we've gotten all the variable ones extended. The nice thing about extensions is there's no prepayment penalty. So say things get way better, we will be able to sell early and still make a profit. In terms of rate caps, the Fed has said they're not going to increase interest rates. Of course, that's not 100%, but we'll probably have some type of drop in interest rates. But we assume any of the interest rate caps that we have to buy are at current prices, and current prices suck. So what we're doing is we're buying 6 months at a time, because that gives you a chance for rates to drop, right? And you're not locked into a 1 year or 2 year interest rate cap. And there's really not that much difference in terms of pricing. It's a commodity, so you know, 1 year is a little bit more than 2 years and such. So what we are pricing right now with current prices. So we should be overestimating how much we're going to pay. And overall in our portfolio, we only have to buy a couple interest rate caps because most are fixed anyways.
Yeah, someone asked here, percent deals in the future, what's in the pipeline? Will it still be co-GP ones or different direction with better terms for us as a group? Since Sunrise and Chandler seem similar to any other deal. I actually don't think it's actually similar to any other deal, especially considering the market today. I challenge people to look for a similar deal. I'd say there. But Pranay, maybe you want to give some insight into what might be in the pipeline. I guess we don't know, but let's
Yeah.
go.
So I would say yes, if you're looking without context, Sunrise and Chandler looks like, Cabana and Kanto and Bethany and Enclave, but we're in a much different place than we were last year or the year before, right? And it definitely a way different place after COVID. So the chances of finding a deal like this in this economy is extremely rare. And we actually were shown this opportunity in September, and we whittled them down in terms of pricing because it didn't make sense. And for us, even a $500,000 difference makes a big deal, right? Because that's profit that goes to our investors if we get a price drop. So I can tell you, in the past 2 years, this will be our second multifamily deal, right? And 3 years ago, we did 4 deals, all multifamily. So in a single year. So it's extremely rare to find deals. And you've probably been noticing the same thing. Your inbox probably got inundated with deals, and now you're probably seeing very few, or you're seeing like 70 units, or in the middle of nowhere, Oklahoma, right? So this is in a great market, a lot of population growth, a lot of employment growth. Intel is building a whole new billion-dollar factory for electrical engineers. So not only are there going to be a lot of new jobs, but a lot of high-paying jobs. So in that sense, yeah, if you look without any context, it looks similar, but the opportunity to get returns pre-pandemic, when interest rates were 0%, now they're 5.5. The opportunity to get those type of returns still is really rare. And honestly, it might be the last deal in terms of multifamily we do all year, because last year we only did one deal, right? And we don't have to do deals to keep the lights on. We just do them when it makes sense for our investors. So in terms of multifamily, this might be our very last deal for the year. Of course, we'll be looking. It's just nothing is really penciled in. And
Yeah, we just saw
price.
a deal. Somebody, I don't know. Just to give you an example, we
Mhm.
saw a deal that somebody else recently raised for their leverage still to make the numbers work was like 90%.
Yeah, oh, yeah, yeah, yeah.
We're shocked. I mean, and we're like, okay, we would never, again, there's nothing right or wrong. We don't want to judge anybody else, but like if we saw deals like that, I mean, we're like, there's no way we would do those. And so it would have to be a situation for us to do it. The story has to be right. Again, considering all the volatility and this sort of thing, we want the cash flow. We want there to be good opportunity. We don't have, again, we don't have to do any deals. So if the story's right and it makes sense and we think it's a good opportunity for people, we're going to do that. if you saw the last deal that we did before, we did a pref equity deal. And so we're open. I mean, we're open to different types of opportunities if they make sense. But again, and we're talking, trust me, we're talking to people constantly and we're looking at opportunities. But again, we just kind of been batting them away just because it didn't make a whole lot of sense. So we're not sure what's down the pipeline yet. Again, but what we do know is that we're really focused on the story and again, cash flow and value. And so if that's not
Yeah,
there,
and with the large institutions, a lot of REITs are going to start buying more. It's going to cause prices to jump up. So you have a kind of a rare opportunity to buy before all these other people jump in. So then we might be priced out, right? And we're kind of waiting to see for there to be a reset because prices dropped a little bit when interest rates went up, but not that much. You've probably noticed the same thing if you looked at any investment properties. Nothing cash flows, nothing does any of that. So the chance of having 3.5 to 5.5% with an interest rate in the low sixes is pretty diamond in the rough, I'd say right now.
so keep coming with those questions, you guys. We're here for you. And again, we can't stress how excited we are about this opportunity. It's not just saying that because again, we holy cow, when we got this through one of our networks and we went through the process and um, we felt like this is something we could be proud of and really stand behind. And so, we love the tough questions. We love what you guys are bringing to us because again, we want our community to be sophisticated and ask the tough questions, and you guys have delivered on that. So we're doing our best to answer. And like I said, I think we're a little over halfway close on this. When do you anticipate closing? Definitely closing in a few weeks. That's not only trajectory, but we want to make that happen. And so it's that's the plan. And so I don't know. You want to add anything to that, Pranay?
Yeah, I mean, this is 3 times the size of our last preferred equity deal. So it's expected that it's going to take a couple weeks longer than that. Uh, and also during tax time. So we're more than halfway, about 60%. And I think once we get to 80%, it'll probably fill up in a couple days. Us doctors, we're always waiting till the very last minute to do anything. So if you definitely want to get in, I can tell you every single one of our deals, every single one, people have emailed me after regretting saying they were just about to get to it and weren't able to make it in. So I would definitely, if you're interested, I'll put my calendar link. Happy to chat, happy to go into detail. But definitely let's start the conversation.
Okay, Pranay, someone asked about K1 in year one, and we talked a little bit about taxes. I think that's an important aspect.
Mhm.
I know a lot of people there love getting, taking some of the paper losses to offset some of the capital gains on some other stuff that they have or on some real estate, some returns and that sort of thing. Yes, we anticipate, of course, you're going to get a K1 in year one. You'll get one. Everyone gets a K1. A K1 is basically an owner statement that talks about kind of your stake in the deal, and you guys are owners in these deals. I mean, your equity, and so that will come. Bonus depreciation, cost segregation. Pranay, you want to speak to that a little bit?
Yeah, so we will definitely give everyone a K1. So in terms of depreciation, right? Depreciation basically just says that you have a physical product by the government that over time it is worth less and less, right? We know real estate, it's just a paper loss, not an actual loss. However, you're also able to, when you have a physical product, you're able to say, the carpets, the windows, they have an accelerated depreciation cycle, meaning you probably have to replace them every couple of years. So we'll let you take a lot of that depreciation in the first year, along with something called bonus depreciation, which the government says whatever depreciation you get, you can add on to that, right? And a couple of years ago, that was 100% extra. Then last year it was 80% extra. Now it's 60% extra. They're talking about bringing it back to 100% At least for now, it's 60%. So how does that translate to you? From $100,000 investment, that'll be about 40 to 60% in negative losses in the first year. So if you put in 100,000, you should get anywhere from 40 to 60,000 negative uh, on your K1. So that means any return that we give you, which starts about a month after we close the investment, will go against that negative number. So you're not going to pay taxes on it until we sell the property, which will be in 5 years.
Pranay, can you speak to kind of like the value add expected in year one in terms of like what the business plan overall is, in terms of, I think
Yeah,
people
so
know that again, it's 97% occupied right now. So, and then only 11% like have been renovated. So there's definitely some meat on the bone that they call it. So I guess somebody has a question about what that'll look like.
yeah, so right now we're kind of in a choppy space, right, in terms of the economy. So we have the ability to renovate 6 to 10 units a month. And we already have a contractor. We own two other properties with Sunrise. So we know we can get a good scope. We don't have to go out, find contractors, which is actually very hard to do right now. And the ideal occupancy is actually 97 to 98%. And that's because you want there to be some vacancy, meaning some empty units, because you can go in and renovate. So we will renovate, anywhere from 5 to 10 a month. And then really make sure that those are getting rented out for a good price. And if they continue to, if we don't head into a major recession, we'll just keep doing 6 to 10 a month. So in 2 years, we'll be fully done. But we'll also keep an eye on the market, right? So if the renovated units are slowing down a little bit, maybe we just do 6 or 5 or 3, right? So we'll keep an eye on it. We'll do a majority of them by the end of 5 years, but that's why we also have a fixed 5 year loan, right? We don't want the business plan to be squished into only a couple years, right? Because we don't know what's going to happen in the next year or two. I think after that, there should be some stabilization, right? In the next, I'd say 3 to 4 years, but that's kind of what the value add. But we're seeing the premium of $300 plus for the renovated units, and they're all rented out. I mean, there's only a handful of units not rented out, but we're seeing a big premium, and people are willing to pay it. And across the street from Sunrise on Chandler is a property. The rents are about 100 less per unit, but even the renovated units are almost as ugly as the classic units at Sunrise on Chandler. So, and they're 98% occupied. So only $100 less, but the scope of renovations is much less than what we plan on doing.
Somebody asked about Arizona state income tax. Yes, Arizona does have a state income tax. When do you anticipate will be need to begin filing returns? That's a discussion with you and your CPA. We're not tax professionals. I will say that you're going to start with losses right away, so you can claim some of those losses if you want to start filing returns. Again, you have to talk. I've heard strategies where people don't file the returns until they can make use of whatever is on the K1. Rarely does a state come after you for losses than they do for gains, but you have to decide with your CPA how and when that happens. And so I think everyone plays it a little bit differently. So I would defer that discussion to your CPA on that. But yes, it does a state income tax. So
Now, let me answer one last question from Jeff in talking about the close date. So as of right now, it's end of May, but we have a really good working relationship with the lender, so we can extend if needed. But so far, it looks like we should be able to do that. And we're actually in discussions with a couple of multi-million-dollar checks right now. So especially if those go through, we should be able to close pretty soon.
yeah, I mean, I think in our mind, it's not a yeah, I don't think there's any sort of worry about not hitting the full race. I mean, we've always done it, and with the trajectory and the community here. I mean, again, to talk about it, we'll be there, and so we're excited to get this closed, and moving into the summer, and get everybody involved in this. So it'll be pretty exciting, and then we can start working on getting those distributions on this one. And again, it's in line with all the ones that we've had in that area. Like, we're not new to this area, by the way. We're not new to Arizona, Phoenix in particular, the Scottsdale, Phoenix, Scottsdale, that whole kind of sub market. That's something that we've really focused on. And again, we've got great people there, great team, all of that. And so yeah, we're ready to get on this. So I mean, if anybody's interested, of course, I know many of you have already, actually, there's some people on here that I've already seen that have already haven't invested. That's great. And so I think they just want to always just listen and learn and hear more. And I love that and welcome that. But if anybody else wants to have a discussion about that, we're here. Pranay put the link to his calendar. We'd love to have you as part of it. Again, what you want to do is that this is a good time. I mean, this is a time for all the flurry of activity tends to happen. And it's just the way in nature is, of these deals. I mean, the flurry of activity always happens in the last 2 weeks or so. But it's an opportunity. We'd love to connect with you now and, and let us know what we can do to help you move forward with this. So really, it's a pleasure. Love talking to everybody here. Enjoyed the discussion. We'll probably have more of these if you guys need, and keep bringing us your tough questions. We love it.
Awesome. Thanks, everyone. Chat soon. Bye.
Okay. Thanks, everyone. Bye.